It's actually not very good coffee. Ugh. Anyways, guten Morgen. Yeah, time to get going. It's 7:10. My bad. Sorry. 7:10 on Wall Street. Still about 2 hours and 20 minutes before the open of trading. See, we got to get ready to front run the market open, huh? So, welcome to QuantBox Live, where we get our global macro on. The goal is to uncover any underlying intrinsic trend, both short-term and long-term. We want to line up, ideally, macroeconomics with technical analysis. So this is where we focus on the fundamentals. Very cool. So we want to look at a whole bunch of different markets and see how things are moving, where things are moving, why things are moving, and then find and drill into specific assets. Are they likely to go up? Are they likely to go down? And why up, why down? Okay. Now, we've already covered this yesterday. Smart Money Tracker is the commitment of traders report. These are long-term positions and flows. We also have long-term analysis as far as central banks and what they tell us about their future expectations for inflation and interest rates. So you never have to watch somebody on TV tell you their guess on if the Fed's going to raise or not. We already know what the Fed is thinking. And then, of course, we have this really cool page, very important. It's a risk gauge. And what we're trying to do is indirectly observe what the overall market trend is. This will tell you when to hold your positions and let your winners run, or if there is no underlying intrinsic trend. If you happen to be sitting on a profit today, it'll go wink, wink, nudge, nudge. Maybe you should take your profit because it's not likely to run. What you've done today in that scenario is you got a good relative strength. So you paired something that happens to be strong today versus something that happens to be weak today. But there's no logical reason why it'll continue tomorrow. Maybe it will, maybe it won't. In that scenario, you're better off taking profit. So if you want your thoughts to be organized like this, YouTubers, swing on by QuantBox. Take a trial. It's $8. Could change your life. Well, at least change your trading. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's get into the dashboard. Let's check the alerts. Let's see. Boop, 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 boo. Boop, 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 boo. What email? Here we go. So I have the pre-London and pre-New York alerts sent to me. In this case, these are pre-market alerts. Sometimes it sends other types of alerts, but this is the pre-market reports. And you can see there's been a big change in gold, big change in S&P 500, big change in Aussie Swiss franc. And this is all an hour ago. So again, pre-New York. This was pre-London. Aussie Kiwi. Look at it. Look. Wow. Like lots going on. What this is doing is pushing you in the right direction to say something is happening based on a change overnight in macroeconomic sentiment. There may not actually be a trade because it's not really looking at technical analysis. Now, when you get an alert as far as a fundamental trade alert, and this also does that, it's not just pre-market opens. You get a fundamental trade alert, it'll actually tell you what changed. Why did you get a fundamental alert? Okay, and it'll tell you specifically the change in the macroeconomics. So, anyways, it's a very cool service, but what it does is it's just going to save you time. Most of the In most cases, it's just saving you time and say, hey, go check out these things. And if you see anything technically, you might want to think about taking the trade. You see, it's a focus mechanism based on logic. You're only going to get a score flip if something in the economy has changed. Okay, cool. All right. All right. What do we have? Yields going up. Boo. I don't like that. Oil's back over 84. It was 84 and a half. Then it was 83 and three quarters. And so it's been bouncing around, but over 84. Remember, I had it at 76 and out at 82, and now it's recovered. All right, cool. Now we're up at 84. So it's still climbing. Okay, it's still climbing. Gold still flat. S&P 500 still flat, but not falling. Euro dollar still around 107. That's had good days followed up by bad days. You could look at the CAC, for example, which is the French stock market. It's been up and down based on, kind of what we were talking about yesterday, where there was a narrative in which everything was rallying. I'm like, yeah, I get that, but I don't know if I believe it. And sure enough, the next day it's all it's all gone. Yeah, you gotta be careful what you believe. And Bitcoin, yeah, okay, Bitcoin. Well, it's kind of just been there a while, hasn't it? Yeah, it's been there a while. Let's look at the risk gauges. Once again, just a quick reminder, we've added the put call ratio and we've added short term treasuries, not just long term treasuries. Oh my goodness, beautiful. Yeah, beautiful. Truly is beautiful. It's cool, man. Cool beans. So right now, mostly risk off on the short run. Okay. Mostly risk off. So if you look at weekly, okay, gold is up a little bit. I have that as a negative. You could have that as a positive. It just makes it -3. But gold is going nowhere. Look at over the last 30 days, gold is up a 0.5%. Sucks if you're a gold bug, huh? Yeah. Well, you got to remember there should be a logical reason for gold to go up, and we haven't had that logical reason for quite some time. Months, in fact. So yeah, interesting. So that makes sense. Yen week over week hasn't done much, month over month down almost 2%. Not a big deal. Okay, but you can see there's a divergence that are kind of happening, but not by much, like not a lot is happening. Uh Over the last 7 days, like S&P 500 is flat. Is that good or bad? Neither. Treasuries, yields are up. Okay. Okay, yields are up. That's bad, but month over month they've improved, so that's good. So you see, like, it's a time frame issue. Okay, it's a time frame issue. So it's not like the economy is collapsing, but it seems like the market is taking profit on the good trades. You see, and that is a seasonal thing. It's like looking at this, like, what day of the year do farmers harvest? Well, it depends on your location and a bunch of other things, the crop you planted. But what we're looking at here is some of the farmers have started to harvest. Not all, but some. It's starting. It has begun, is one way of looking at that. Uh-huh. overall, this is a good trend if you look at the direction here. Okay. If you look at the direction, okay, this is good. But popping up and trending up above what has been, that's the 8-day average. Well, that's risk off. Uh-huh. And this is the 2-year yield that we put into the risk gauge. Okay. So it's the crossover that I'm looking at. Uh-huh. Okay. And this occurs when yields are rising. And when yields are rising, it costs more money to do business in America. It's just not good. Again, the way to think about it is if you had a variable mortgage, you just got your monthly mortgage payment and it's higher this month than last month. You're like, oh, God, dang it. Okay. Can't go to Applebee's this month. Yeah. Right. Your mortgage went up. So not good is that's how you want to look at it. Now that's sort of like a mortgage payment for business. Okay. In particular, if I see this, I would think the Russell 2000 would be hurt more because not only do they have to go to banks to borrow money versus going to the issuing a bond into the market, banks tend to be a little more expensive. But if you're a small business and you have equipment and a factory, and those things are probably financed. Okay. They're probably financed, and that's going to cost money. Okay. Versus if you're an S&P 500 type company, it's probably not financed, right? All right. So, anyways, they have a greater sensitivity to uh, interest rate changes. That's how you want to look at that. Looking at what the option boys are doing, once again, it's the direction, just like the hot money I just showed you. Okay. The short term treasury market is completely independent from what the options traders are doing. They don't talk to each other. They're not, they might be in the same building, maybe they're not in the same building. Right? You know, they don't go to lunch together and share notes. But the option market is risk on, but a lot less risk on than before, you see? And so that also goes into our risk gauge model, and things are changing. Okay. So on the long term, as I just showed you, the options guys are, I believe, right? Yeah, risk on. But on the short run, risk off, meaning it's moving up, but it's still trending down. There's a difference, right? Yeah. And we see that here. Isn't this brilliant to be able to get all of that? So in like seconds, you can look at all these markets and go, "Yeah, oh, yeah, I see this. It's in my score. I see this. It's in my score." Okay. It's nice. Yields up dramatically. Boo. I don't like that. Means the bond market, or in this case, treasury market, is falling. Wah, wah, wah. Well, to be honest with you, I'm exposed to that market. Yeah. So, wrong direction for me. Here's the thing: when the Fed cuts, this is going to drop. So, if the Fed's going to cut this year, I'm going to make money. So, we're debating whether that's going to be September or December. That's what the market's debating. Right now, I think people are just walking away from the market. Okay. DAX down, NASDAQ down, Russell down here, right? Again, you can see that the hot money up, Russell down. You see the logic there? I mean, that could just be, that's what your trade could be. Do you understand? Like you could specialize, right? Hey, what do you do, Jimbo? Oh, well, I trade the Russell against the 2-year treasury market. That's it. That's all you do. Yeah. Okay. Interest rates up, Russell down. Interest rates down, Russell up. That's your whole thing. I mean, look at yields here. And this is down, right? You got to look at what gets impacted. Okay, Nikkei up. See, this is what we suspect. So in Investor Boot Camp, which you're probably a member of, I run a day trading group. And we're like, hey, man, there's nothing to do right now except sell yen. Now, if you're selling yen, you want Nikkei to go up because there's a relationship we call correlation. So if Nikkei is up, almost certainly yen is weak, which means you're long the yens, which we are. So, right? So as they, right? So as they say in Austin Power, on the whole, it feels good. Dollar strong, dollar strong, dollar strong, dollar strong, risk off. Dollar strong, dollar strong, dollar strong, risk off. Boo! But it makes sense this time of year. So one of the things I think we focused on yesterday in the QuantBox video was don't trade the dollar. But look at cross pairs, do relative strength exercise. If you did, everything down here is down and expected. Everything here is up and expected. Okay. Yeah. Okay. Kiwi week, Kiwi week, Kiwi week. Kiwi week, Kiwi week, Kiwi week. I guess Kiwi is weak today, huh? Okay. And by the way, bearish and expected and bullish and expected. So the only odd man out here is Rand. And for some reason, whatever, it's got a negative score. But under these circumstances, I would assume dollar strong in my mind. But I'm not a quant. Well, I'm a quant, but I'm not a machine, right? So I don't know. This makes sense to me. It's okay that it's up in my book, in particular on days where the US dollar is strong. Okay. Yeah. How's the commodities doing? Let's just, right. Gold down, but that might change. It's got a bigger score than it used to. That's what the emails are about, because you might not have seen that. Do I still have it? Let me open it up here. It's hard to track all this stuff, but an hour ago I got an email. It was like gold went from a 2 to a 6. Oh, really? Oh, oh, oh. Okay. I might be burned, but the question is, do I know I'm a robot? Have you seen Ex Machina? That's kind of an interesting movie. Yeah, it's a good one, right? Yeah, it's pretty good. The scary thing is, I want to be the billionaire that just lives in the middle of nowhere underground and nobody bothers me. No neighbors. Yeah, I'm like, it's lonely. You just live underground with a bunch of robots. Yeah. It's a weird thing to want that, huh? Yeah. We call that crazy old man. Yeah. All right. Let's take a look at the world today, Tuesday. So, by the way, at Investor Boot Camp at 4, we are going to read a whole bunch of economic reports. Okay. And we are so close, by the way, to have AI summarize all the reports for us. Yeah. We are very close. We worked over the last couple of weeks while I was sick. This is why you have teams, right? I'm laying in bed like I just want to like melt. And then ping, your phone goes off, and some guy on the other side of the world is working hard for us. Yeah. Hey, yeah, Denise's ECB forum. It's in Sintra. I was just in Sintra a few months ago, and it's a really interesting, cool place. Like, I'm surprised that there's even space for these guys. But there's a place in Sintra where I think the Masons used to meet in an underground well to do their secret rituals. And I'm like, is that what the ECB is doing? Does anybody know the history of Sintra and the well I'm talking about? Dude, all right, let me show you. Look at this. This is a real place in Sintra. And this was a well, okay, built in the prettiest. That's funny. Uh yeah, it's a little old now, but you're like, hey, do you want to go down there and do some rituals? No, my cape is at the cleaners. But you're like, whoa, dude, what goes on down there? Yeah, ECB meetings. Yeah. So, anyways, right? So, anyways, yeah, look, core's below 3. Okay, 2.5. Okay. It's just like it kind of gives us stalled out where like ECB has cut, but they're not likely cut more, that kind of stuff. I don't know. Like, I don't know. Jolts today at 10 a.m. That'll be interesting because I think the Fed, based on recent speeches, are kind of like okay with how inflation is going. So now they're switching back over to the other side of the mandate. So they want to see the job market cool but not crash. But because this has to do with wage inflation. And so Jolt shows vacancies. So if that comes down on trend, the Fed is going to feel more like they can cut soon. Now, I've shown you because QuantBox is amazing. We can go back and look at the magic number of being 7 million. So we have some work to do, but we want to be in that direction where in the next 2 or 3 months, if we can get to below 7, oh yeah, the Fed's going to cut. Right? You see? That's and we have that in QuantBox, which is really nice because I have the average. We've calculated the average based on our own models, right? We have an expectation. Okay. Cool. So that'll come out at 10, and that's important Tomorrow's the big day. Big day. ADP, scalp. Weekly claims, scalp. ISM services. And you want to look at the subcomponents like employment for the employment, sensitivity here that the Fed might have. But how about leading indicators like new orders? Well, if we're not getting new orders, what's business going to be like in 6 months? Up or down? Okay. So that's informative. FOMC meeting minutes. Again, wow. Wow. What is the Fed thinking? Yeah. 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 So busy day. Thursday, the Bank of Japan is going to intervene. Are you ready to rumble? So while you're, drinking Bud Light and blowing up things with your firecrackers, including your thumb, okay, there'll be fireworks going on in the Forex market. So you might want to figure out what 9 a.m. Tokyo time is for you, or 10 a.m. Tokyo time. And maybe that's when they jump into the market. Okay. For them, it'll be 9 a.m. Friday morning. They enter the market. So for you, probably 9 p.m. And there's fireworks going off in the sky, and there's fireworks going off on the yens. Yeah. Real. All right. So, anyways, and then Friday NFP. Why do I say that? Because I'm magic. No, think of this, Dan the man. They probably want to intervene, and it costs money. The way that intervention works is they have to buy their own currency. Okay. So they have to buy it from the interbanking system. Well, if everybody's long, now they have to fight everybody else. I mean, long, they're short the yen. Okay. So everyone is shorting. Now you got to go in and buy, but everybody's shorting. So it's you versus them. If you're going to move as a central bank, the yen by 500 pips in a day, you have to buy more than everybody's selling, and everybody's selling. That's a lot of money if you think about it. The entire world is selling, and you have to buy enough that you overwhelm all the sellers and strengthen the yen by 500 pips. Oh my God. That is a lot of money. Or you can wait when nobody's trading and everybody's worried. You want to get everybody worried, so they jam all their stops close, right, Dan the man? Okay, so now nobody's watching the market. Everyone's jammed their stops. And now when nobody's looking, nobody's watching, nobody's trading against the Bank of Japan, they intervene. And you'll get the biggest bang for the buck. And so what happens? The ends move 500 pips, but what's actually happening? You're wiping out everybody's stop and you're taking them out of the market. And you do it for the least amount of money because nobody pushes back. What'll happen is it'll cascade. So you take out, let's say, the first 200 pips, but if that's 40% of the market, then the market drops another 300 just out of people's stops being hit, not because more money was spent by the Bank of Japan. Because nobody's buying the dip, because nobody's watching the market, because they're watching the fireworks on the 4th of July. Okay. Or you're in Europe and you're sleeping. Okay. So nobody's going to be at the wheel. Nobody's going to be at the helm. So that's my wild and crazy guess based on logic. So if I was running the Bank of Japan and the powers that be say, hey, we want you to intervene, I'm like, I got this. Oh, you can't time it. Okay. You'd have to be there and watch it. Okay. Because if I don't know they're going to do it, I certainly don't know when they're going to do it. If I don't even know they're going to do it. But if I was going to be the one in charge, that's when I would do it. Okay. Yeah. But you could say, no fireworks for me. I'm going to stay sober. I'm not going to watch the fireworks. I'm not going to blow stuff up. I'm not going to fire my AK-47 into the skies over LA like I normally do. Right. Yeah. Uh, and instead, I'm going to trade. And when there's an intervention, you'll probably see a pop, and they're like, "That's it." And then you do your best to grab it and hold on for dear life. Okay. Yeah. Now the way that I've done it, Dan the man, on some of my yen pairs, I looked at monthly pivot points, like hundreds of pips below us, and I threw down a limit order. So if they drop 400 or 500 pips, I'm going to buy them with 111 pips stop and a 333 pip limit. Now, if I actually catch it, 333 pips is not going to be enough. So I might move that to 1,111, but I'm only going to risk 111. I don't like doing that, but fortune favors the brave and the stupid. And it's going to be one of them. Yeah. By the way, yeah, well, let's just skip that. Let's pick one. Kiwi yen, just randomly. I want to just look at a yen pair. And I want to point this out. I pointed it out yesterday, but we're in the period of July, and it smells like down to me, huh? No, I don't, Burn. What I do like is seasonality. Okay. So over 20 years and over 5 years, this July to September period is down. And so, how is that going to be different this year than typical years? With the thing is, if the central bank intervenes in this period, maybe it'll have more impact because the market wants to fall anyways. Okay. But I want you to also look at this period and say that is dramatically too high. Yeah. And this is why you get intervention to begin with, huh? Right? Like, whoa. Yeah, well, the whole world is short the Japanese yen. Yeah. Kind of interesting, huh? Whoa. We're trying to get back to normal. And now, as far as percentage change throughout the year, we're closer to normal. This percentage change, right? Now, maybe that's Kiwi playing, right? You check Euro, get not even in Asia Pacific. Okay. And see how we're normalizing. Check that out. Isn't that beautiful? Oh, God. Look at that. Normally down to September. So somewhere between August and September. So in a normal year, I buy either the 3rd week of August or the 3rd week of September, depending on what's going on that year. And as you already know, I've delayed and deferred that rally. This rally here, I've delayed and deferred it to the end of the year. Oops. Okay. Interesting, huh? Do you guys spend time on these charts? Do you spend time on QuantBox or do you just wait for these meetings? Like, do you just spend hours going through these charts and you're like, this is cool, man. This is cool. Do a North America, maybe cadmium. Yeah, you use it a lot. Cool. Okay. Once again, delay and defer the rally. Okay. And I want you to see that there's a shape to the market. So even though this is down, it doesn't necessarily mean the markets are, you know, but you can see, oops, let me get out of here. You can see that there's still more up. Okay. But when it comes to CAD yen, something about what is that, the second quarter? Somewhere between the second and third quarter, things start to get juicy. Okay. Well, it depends on where you start from. So you can see at the end of the year, this comes down more than I think some of the other pairs, but you start out low. And from there, you can build up your position. So you want to catch the low to high. So really, yeah, right there. Week 11 on average over, right, over the long term, which is probably in here, is when you start accumulating. Okay. So, like, this is showing you the up, the down, the up and the down month over month, but you want to build up. Okay. Yeah. And, yeah, I see the comment there, Denise. Yeah. Yeah. This is always a good place to start. Now, the thing is, Denise, over time, significantly more data has been put into this score. Okay. Yeah. So notice, like, recently, the Swiss National Bank change in policy has been reflected in the score. It took a little time for it to get into the score, but it's because QuantBox doesn't say, oh, the Swiss National Bank is cutting interest rates, therefore we should be long. No, no, that's what we do. What it does is quantitative analysis. So it says, well, because of what the Swiss National Bank is doing with their policy, aka cutting rates, you start to see it impact different sectors of the economy and then notices the changes and then moves the score. So it's not guesswork, it's seeing the evidence of the change or the impact of the change, which I think is really cool. So, anyways, there's a lot of, sell Swiss franc now. Yeah. Not too many things bearish at the moment, huh? Shows you how terrible Kiwi is if Swiss franc is stronger. Okay, Kiwi, terrible score, huh? Terrible score. Okay. Sometimes, there's different tricks to kind of use this. You want to, one of the tricks, of course, is to find something that has trend opposite of bias. Okay. Yeah. Okay. I don't really look at this too often, but sometimes what you want to see is where retail is heavily opposite of institutional. Still very heavily short, very, very heavily short. Remember, so Swiss franc has moved from the middle to the bottom recently because of the change at the central bank. It's very important to note that. Okay. And yet, retail's not quite on the clue train. Like in that case, they're long the Swiss franc. In this case, they're long the Swiss franc, long the Swiss franc, long the Swiss franc. That's not logical, huh? No. Well, it's retail. Okay. So okay. So again, this is sort of like a glancing fancy. You just kind of look at it, but it's nice to be able to have that. So now we've noticed, and in fact, we covered it yesterday, that there's very few things trending right now. The biggest one might be USD yen because we're in a period where the dollar tends to get strong if you look at seasonality. Well, in fact, why don't we just quickly look at that and come back to this? Maybe I'm remembering it wrong. Let's see. Euro dollar tends to fall soon. That's dollar strength. Okay. Pound dollar tends to fall soon. That's dollar strength. See? USD yen tends to rise this time of year. That's dollar strength. And you see that across the board. So I am right. Good. So then you go back and you're like, okay, well, if USD yen tends to rise soon, should I be a buyer? And we're already, in a positive trend of buying the dip. Now, of course, our fear is central bank intervention. Yeah, well, use a stop loss, my friend. Okay. Okay. You have to get out of the basement every so often, get some sun on your face, right? Yeah. Don't fear, just be prepared. Use a stop loss. Okay. But you can see like even buying a dip scenario is cool, but we're well above the trend. That's beautiful, right? Yeah. But let's maybe I don't know, let's throw euro on here and compare and contrast. Hang on. Look at euro dollar, for example. Okay, a little bit of dollar strength. Not as clear though, right? Look at we're on the moving average, but we were a little bit high now. So you would suspect down, but hard to call, right? So you go back to the yen pairs and maybe you see some congruency on the yen pairs. You're like, well, that's definitely not bearish. That's definitely not bearish. Okay, that's definitely not bearish. You're starting to see the trend here. Even Swissy, maybe. Even Swissy is stronger. CAD. So this is what we concluded yesterday, that there's the only really thing to be doing right now is buying dips on yen pairs. Okay. Okay. Buying dips on yen pairs despite the neutrality. There's nothing else really going on. Maybe some exposure to the stock markets or stuff, but I'm very worried about that being toppish as well. Okay. So you got to maybe start with what you think is, your favorite. And it's neutral because typically this doesn't work this time of year. I mean, that's the problem. That's the problem. And you know what we call this, by the way? This lack of congruency. Like, it's neutral. Why? Because this typically doesn't work, but it's working. So, do you know what we call this? We have a technical name for it: summer. So, right now we have a currency that is trending when it typically doesn't trend, and nothing else seems to be trending at all. So, what's going on here? Well, summer means nothing tends to trend well, and there's more profit taking. Like, if something is down after being up for 6 months, it's not necessarily people selling. They're just getting out of the market because it's summer. They don't want to watch the market. They'd rather be in cash. Great. But the other thing is, like, well, yens typically fall. Why are they rising? Well, it's the monetary policy of the central bank this year versus, which is different than 20 years ago. It's different than 5 years ago. So something unusual is happening with the yen. So you have to be able to understand that and say, well, that's why I'm interested, because it is unusual. But because it's unusual, you say, well, I'm going to trade it. It is what it is. The consequence of the monetary policy of the central bank. But because of things like the risk of seasonality typically doesn't go this way, then maybe I should use a stop loss. Yeah, maybe you should. But like when you look at the COT data, institutional investors are on this trade. Seasonality, typically it doesn't work. So something is really strange. Well, that's the difference in the monetary policy. And is this CAD? No, not necessarily, right? Okay. Or pound. Okay. And you go through this and you do your research. Look at retail's short this. Really? Weird, huh? Okay. Yeah. Very weird. By the way, like, this is a little clunky. The output is gone and stuff. All of this is being worked on. There's a massive upgrade that's going to appear soon. Soon meaning a month, but there's massive things going on in the background. Yeah. Okay. So, anyways, but you can see, like, the discrepancies of normality is why you might be trading this. But the discrepancy of normality is also risk. So use a stop loss and you should be fine. Cool, right? Okay. Stock market is still technically bullish. Okay. July has eked out profits, but my experience, it's in the first like week of the month, and then fizzle, 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 fizzle all the way down to September. So don't be shocked. Okay. In fact, be prepared. It's the opposite shock. Be prepared that this is bullish, but notice that it's less and less. And if or when we dip below this, be prepared that it can be July, August, and September. Okay. I don't look at this as like July up. Oops, let's do this differently. And I'll use the arrow and I'll make it thinner. All right. Don't look at this as July up, August up, September down. I look at June and sometimes even May, but definitely June, July, August, September. It's the relative change is what I look at. And then WWWD, what does Wayne do? Somewhere around here, I buy it because it's down. No, not because it's down, because that's the bottom and we're likely to then go this way. That's how I want you to look at this. So it's more like we're in this period. What does that tell us? Oh, definitely. We typically top out. So if we drop below, okay, we're definitely very, very likely to have a change in direction. Again, it's not really people selling, it's people taking profit. And then they buy it back here and they get back into the game. And right? And you can get this like September, October, November, December, January, right? And then we have this drop. This is the sell in May and go away thing. But I've taught you over the years what I like to do is buy in May and go away. Okay. Now this is this year. This year was dramatic. April was dramatically down and very unusual. What I see again is typically there is a normal move this way. So at the end of the first quarter, beginning of the second quarter, I typically buy. I accumulate, and then this period here, I tend to accumulate. So if I only worked 2 months out of the year, it'd be these 2 months. Okay. But you're like, but Wayne, it's up and then it's down and then it's up and then it's down and then it's up. So on average, nothing happened, right? No. And that's why I added in the seasonality section for your research. I have to give you more information. So you go to seasonality and what were we just looking at? SP 500. Pull this up. This is the same data. Okay. Same data, just instead of bar charts, I could easily just make these bar charts. So on the other screen, I have bar charts just as a slight difference. You might prefer one over the other. You can see the blue line. It's loading. This is a lot of data. Okay. Come on now. All right. I don't know why it's logged on to one particular. Why is it stuck? By the way, look at all the years going into the calculation. 10 years. I'm not sure why it's stuck there on 1 week, but what I want to show you is hopefully you can see these. This is the shape. Okay, starting at 0. Nobody owns the S&P 500. Okay. Okay, there's buyers and there's sellers and there's buyers and there's sellers and there's buyers and there's sellers. and there's buyers, and there's sellers, and there's buyers, and there's sellers, and there's buyers, and there's sellers, and there's buyers. There are more buyers than sellers throughout the year. So when you look at seasonality as a bar or as a line, it looks like this. And you're like, well, then nothing happened. No, but there's more up than down. And so it's more like I like to buy around here and I like to buy around here. So you get your rally, your pullback, and your rallies. And what I said is if I only work 2 months out of the year, those would be the 2 months. And you know what the weird, shocking thing is? That could be what you do. You know what we call that? Institutional investing. I used to read Barron's magazine to uh, boot campers. Maybe we should bring it back, but every Barron's magazine, they had an article where they interviewed some institutional investors, and very often it was just two guys managing $1 billion. Two guys managing $1 billion. And they're like, once a year, we might buy a new stock or sell a stock we own. And you're like, wait, what? You live a fancy life with a silver spoon in your mouth. You eat lobster for breakfast. You get driven to your office in a Rolls Royce. You have two swimming pools at your house. And you might do something once a year? And you're like, well, we spend a lot of time thinking about maybe doing something. You're like, you don't do anything and you make like $100 million a year, right? Or you make $10 million a year. Yeah, but I have to split it with my partner. I only get 5 million. You're like, you make $5 million a year and you don't do anything. Well, we sit on the nest, right? Right. And so, like, so imagine now you doubled the workload and you're like, well, we might like to buy things around here and we might like to buy things around here and we might like to take profit here and we might like to take profit there. So now actually you've quadrupled the amount of work. So you have the buying period, the selling period, the buying period, and the selling period. And now we call that a career in finance. And it's okay. You don't have to know what you do. You could have a sports marketing degree. It's fine. You just have to know 1% more than your clients. Okay. Well, yeah. Okay. So that's a long question, Burn, and I've gone long already. Did summer school's even started already? Can you ask me that tomorrow or maybe at Forex today? I'm happy to talk about it. Okay. Yeah. Thank you. All right. So thank you, everybody. Oh, you guys are done? Yeah. Yeah. I've been in a cave for a couple of weeks. So obviously I'm overdue. Yeah. Cool. So Ryan's going to send out a survey. Oh, for today. Oh, it's that fast, huh? Yeah. Oh, I see. So it's happened. You went there and came back. Yeah, well, then, yeah, there you go. Cool. Yeah, okay. All right, cool. Yeah, it makes sense. I mean, it's a market open. Um, right, the rest is just follow up. So oof, oof. Look at that. So that's the scary thing. So I'll follow up and I'll leave this as an idea. So because of the research that we just covered today, things like seasonality, okay, I was prepared for something like this. And with QuantBox, Oops. Yeah. I want you to know that you can be ready for stuff like this in advance. Okay. And is it me thinking that the stock market's going to crash? No, but we know seasonality. Okay, we know seasonality. I just went over it. Now, I went over S&P 500. Well, do the same with Nasdaq. But we look at it and say, well, typically, not every year, not precisely now, but definitely around this time of year on the S&P 500, it tends to reverse and drop, not just for a week, but like 90 days. It's factual. Does it happen every year? No. Does it happen to the same degree every year? No. But does it typically happen? Yeah. So here we are now, and starting the day before Canada Day, which is like precisely when it's supposed to happen, we start to see red on the screen. Really? This is where you just, oh, I'm so shocked, right? Like, no, bro, we know this. We can see it coming. We're prepared. We're organized. Bring it on. And for this to happen, institutional investors must be doing the same. Just like I showed you, there are times to buy and there are some, right? There are times to plant the seeds. Don't think of buying and selling like bulls and bears. No, 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 no. Think about it this way. There's times to plant the seed for profit. And then there are times to harvest. And we have 2 seasons every year for planting and harvesting. And we're at harvest season right now. Not everyone's going to harvest on the same day. There are a lot of different variables, but it is harvest season. Doesn't mean the world's over, just means it's time. And so you can be prepared. And so it's interesting, isn't it? Like that it shows up right on time, or that you can do something like this. Because remember, it is absolute religion in the investing community to say it's impossible to know that that's going to happen. And I always kind of chuckle and I'm like, really? They're like, there's no way you can predict that that's going to happen. I'm like, that's correct. There's no way you can predict that that's going to happen. But if you have the data, and it just tells me people don't have the data, they have guessing and conjecture. There's also like you've been trained, you're not allowed to say past performance predicts future results. Remember, I'm required by law to say that. And it's true. I don't know what the future is, but gosh darn it, isn't it important to be able to say, well, at least I do know the past and I can be prepared and I can be ready. And this is what QuantBox does. It gets rid of the conjecture and guessing. And you can be prepared to harvest. And then, like me shorting here, well, for you, it could be because in some cases, like my retirement account, am I going to sell? Not necessarily. But you know what the reality is? We did. In my institutional pension fund, we actually got out of these trades. Why? It was the likely time to harvest. And what do you think we're likely to do in the future? Buy it all back at a lower price, planting the seeds for profit. What's a hell of a guess, right? No. Even if I'm wrong, let's say, even if the council was wrong and NASI goes up because of AI and it just keeps going up, Yeah, but it was still very possible to happen, and we addressed the risk before we faced the risk. It's called strategy and preparation. You can't have it unless you have good data. So seriously, you can trade like an advanced institutional trader because you have QuantBox. So thank you for being part of this project. I think are we in year 2 yet? But this is our project. And I hope you find it absolutely not just amazing, but thrilling that you have this data in your decision-making process. It truly is a game changer. And I want to thank you for being part of it because I keep taking what you're investing and I reinvest it into better and better and better products. So, thank you to us, right? What a cool thing to be able to do together in this collaboration. And I hope you harvest. I hope you harvest hard. Bounties for everyone. So, anyways, peace on earth. May the pips be with you. May your profits be above average. Have a wonderful trading